DevTech Finance. In this video, we would be learning about the term called exchange traded fund. So let's start. Exchange traded funds or ETFs hold a portfolio of securities that replicates an index and are listed and traded on the stock exchange. So basically, ETFs are mutual fund schemes which are provided to you, and the name which it has got like exchange traded funds is because they are after these schemes are offered in NFO. After that, it get listed on the stock exchange. So normal trading is done in the way you trade the shares in the stock market. So you could trade ETFs also on the stock exchange. So it's the basic feature of this ETF is that the portfolio which it holds that should replicate an index. So for example, for Bombay Stock Exchange, the index is Sensex. So if ETF is building a portfolio, it should make sure that it would replicate the index that is Sensex and would add all those shares which are present in a particular index. So it is trying to replicate index. So whatever shares the index are having, it would be holding the same shares in its own portfolio. Now the obviously as the index would be having a larger numbers, here the numbers would be less, but the ratio in which the shares will be held would be the same, and the as I said, the shares of a particular company will be same as in the index. At least 95% of the total assets should be in securities represented in the index being tracked. So how it would be replicating? So it should be at least 95%, not less than that. At least 95% of the stocks should be same, the stocks which are there listed on the particular index. So then it would be a replicated fund, which is known as exchange traded fund. Now, ETFs are first offered in NFO like all mutual funds. Units are credited to demat account of investors, and ETFs are listed on the stock exchange. So already mentioned, it is offered like any mutual fund scheme during a fixed period, which is known as NFO or new fund offer. So as in the stock exchange, when any particular company introduces its list its share on the stock exchange, that is referred as IPO. In the same way, when any particular mutual fund scheme is launched for that fixed period, it is referred as NFO, that is new fund offer. And ETFs after NFO get listed on the stock exchange for maintaining the trading purpose in that particular scheme. Ongoing purchase and sale is done on the stock exchange through trading portals or stockbrokers. Settlement is like a stock trade, and debit or credit is done through the demat account. So here it is indicating that the trading in ETFs, which is a mutual fund scheme, is done in the same way as we do trading in shares or any other commodity listed on the stock exchange. So, and many times this is done to provide a investment option to the investors where the risk is little less. So we are trying to replicate the index which is representing market. So if the market is going up, our ETF will be going up, and if the market is going down, our ETF will be going down. So try to provide benchmarking to the investors. Thank you for watching. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you all.